Coronation Merchant Bank says investors have had it good investing in T-bills and getting inflation-beating returns for a decade until 2019. The bank's head of research, Czartoryski, joins me now to discuss how investors can navigate the Nigerian investment waters in the new normal. Thank you so much for joining me on the show today, Guy. And I'd like to first start with that point and understand what this new normal means for investing in Nigeria.
Well, Kenneth, good afternoon to you, and great to be in touch with you again. So we published this report in response to several things that are going on. I mean, first, I guess there are 4 points to make. The first is that things aren't like they used to be. You know, I mean, for a 10-year period, people could get an inflation-beating return on T-bills, and that was really very helpful for fund managers and for pension funds. And then in that time, of course, you've seen currency depreciation. So actually, the question that comes up is whether you beat currency depreciation against the dollar or whether you want to beat inflation. And our answer is a little unusual. We say ultimately you want to beat currency depreciation and add the kind of return that you would get in dollars. And then the third thing, I guess, is that have Treasury bills really delivered enough? And the answer is, oddly enough, they have. So if you take dollar depreciation per year over a 10-year period at 9%, 9.2%, add the risk-free return you can get in dollars, which is the sovereign Eurobond rate that Nigeria has averaged over a 10-year period at 5.5%, you get to 14.7%. And T-bills have come very close to that, which is kind of strange and very interesting. And obviously, you know, with inflation, as you said, today we reported 12.56% for June, and the T-bill rate close to 3%. That isn't going to happen anymore. So the question is that now fund managers and managers of pension funds have to go out along what we call the risk curve. And so the question is, do equities return enough? And of course, we're looking for a 20.5% return there because they're risky. And of course, they come nowhere close, but some do. And that's where things begin to get interesting.
All right, Guy, but in your view, though, do you still think that the Nigerian T-bills return enough for the investors?
Well, I think, I mean, very obviously at 3% and actually no bond. So if you go out along the sort of duration into the federal government's Naira-denominated bonds, the highest yield you get there is about 10%. So obviously that is falls short of inflation at 12.56%. So the answer is no.
All right, but looking at how investors can keep up with the fair value adjustment of the Naira, looking at the challenges with the currency there, how can they stay ahead in this space?
So they have to start to begin to take risk, and you can see them doing that. They're moving out from pure T-bill exposure to longer dated bonds. So this year they've been buying federal government of Nigeria Naira-denominated 5-year bonds, 7-year bonds, 10-year bonds. But of course the yields of those have come down as people have bought more of them. So therefore you don't even beat inflation there. So they're taking more risk by taking longer duration. But again, they haven't really got the return that they want. And so what we think they're going to have to do is look at riskier parts of the market again, such as the equity market.
Yeah, but on the equity side, though, I see that you are saying that listed companies don't return what you consider as an adequate, which is at 20.53%, ROE. But I would like you to speak to what we can expect from the equity space going forward with this new investment climate.
So I think the equity market, as you say, what we ask of the equity market is an ROE, a return of equity within the companies, as it were, of 20.5%. And then for them to return as equities, as investments, your capital appreciation plus your dividends, 20.5% as well. And very few companies do that. So I think you're going to move into a phase where investors are more demanding and say, well, why isn't this the case? And by the way, there are some, in the telco space, there are telecom companies that have that kind of yield. In the cement space, there are some as well, or at least there's one. In the bank space, there are three of the banks can actually do that. But again, they don't get the equity, so they get the ROE, but not always the equity return that you want. And therefore, that's a question of confidence in the market and how the equity market can build confidence in itself to bring the investors back in. After all, in most countries, the equity market is a key part of a pension fund's core holdings.
All right, but what about the telcos? Or do you see prospects there at all?
Yeah, I mean, we're very sort of upbeat on telcos, partly because the subscriber numbers are still increasing. It's also, if you look at the economic data, and the economic data is pretty terrible, it's probably the case that telcos are one of the few sectors that are still growing, partly because of what we're doing now. I mean, we're on a internet link, and we're using data, and data has to go across a telco network. So yes, I mean, clearly that's a good sector, and we think certain sectors are going to come out of this period of pandemic actually looking quite good. And if you look across to the US, for example, you're seeing the internet and the telco sector doing extremely well.
All right, but how should we measure the stock market returns in your view? I see that you've come up with you have a template already.
Yeah, so I think I think there's been a lot of what we call derating in the market. You can measure that in a number of different ways, one of them being simply price to book. And that has derated over the period that we're looking at. However, it's up to investors to find the very few companies that give the ROE, the return on equity that you need, and for companies to say, well, we can deliver that, and to build that confidence again. And in that case, then there are, as I said, at least sort of 8 companies that are actually going to deliver the kind of return that you need in a core pension fund holding portfolio over the medium to long term.
All right, but looking into the second half of the year, though, what kind of earnings are you expecting from the major listed companies?
Well, it's not going to be pretty. I mean, we're in the midst of an economic downturn, and it's going to be tough. So I think, on the one hand, earnings may be challenged, although, as I said, I think the telcos might be doing quite well. We'll see that when their Q2 results come out in a few weeks' time. But at the same time, you can always trade. I mean, when you're in a market like this and the market is down 9.5% or so on the year, and there's some equities we follow that we like are down 20 to 30% on the year, you've got to start asking yourself, isn't this the time to begin to fill up your portfolio with the companies that you like?